Ladies and gentlemen, welcome to BOQ's full year financial result for 2017. My name is Tani Mangos and I'm the General Manager of Corporate Affairs and Investor Relations. Thank you for joining us today in the room, on the phones and also by webcast. For today's presentation, Managing Director and CEO John Sutton will provide an overview of the result. Chief Financial Officer Anthony Rose will run through numbers and then John will discuss priorities and the outlook for the period ahead. This will be followed by the opportunity of analysts and investors only to ask questions. I'll now hand over to John.
Well, thank you, Tani, and good morning to everyone. I'll begin with the highlights of BOQ's full result on slide 3. We've delivered a sound result for 2017 with improved performance in the second half. The improvement in both lending growth and in margin is in line with the guidance we provided at our first half. The result has been achieved against a backdrop of industry challenges, including an ever-changing regulatory and political landscape. Our niche segments continue to grow. BOQ Specialist, BOQ Finance and our commercial lending segments have all delivered good results. Virgin Money has also delivered ahead of expectations with growth in its home loan product. Our asset quality remains sound, with further improvement across a range of metrics. This outcome of a deliberate approach to improve risk management over the last 5 years. I'm also pleased to report that we've delivered on our expense targets. We have found savings throughout the organisation which have allowed us to reinvest in our growth businesses. Our capital position is very strong. We are in the enviable position to consider capital management options to deliver long-term shareholder value. Turning now to the key financial elements of result on slide 4. Cash earnings increased by 5% to $378 million. This included a $16 million profit on the disposal of a vendor finance entity. We'll discuss this in further detail. Excluding this one-off item, cash earnings increased by 1% to $362 million. Earnings per share, which includes the one-off, increased 2% to 97.6 cents per share. Return on equity increased 10 basis points to 10.4%. The board has maintained the final dividend at 38 cents to bring the full year dividend to 76 cents per share. The bank's strong capital position is clear following the release of APRA's unquestionably strong regulatory guidance in July. As a result, the board has resolved to pay a special dividend of 8 cents per share. Anthony will talk through our approach to managing capital and the rationale for this in more detail. Moving to the key underlying drivers of the result on slide 5. We achieved lending growth of $665 million for the full year. Net interest margin was down 7 basis points to 1.87%. Our cost to income ratio was down to 46.6% and our loan impairment expense reduced to just $48 million. This is a reflection of the continued improvement we've seen across the portfolio. One of the most pleasing aspects of the result is the improved momentum in the second half as shown on slide 6. The second half largely played out as we said it would at our first half result. Lending growth improved significantly in both housing and commercial loan portfolios. Net interest margin rebounded in the second half to 1.9%. This was driven by a recovery in term deposit spreads, which we flagged at the first half result. We also saw a further reduction in our loan impairment expense, and I'll talk more about asset quality shortly. Slide 7 shows the improvement in the housing loan growth across all channels in the second half. The branch network remains a core part of our proposition for customers, not only in lending, but increasingly for deposits. We've been through a period of transition, improving the quality and compliance standards of the network. We've rebalanced the franchise commission model and increased the focus on customer retention and deposit gathering. Although our branch numbers have reduced in recent years, we are now at the point where we expect our branch numbers to stabilise. We're focused on developing a good pipeline of quality new owner managers. This will help us manage succession planning and ownership transitions across the network. The second half saw momentum lift in broker channel across both the BOQ and Virgin Money brands. This included broker settlements nearly doubling for the BOQ brand in the second half compared to the first. We've been working hard to improve our processes and turnaround times. We're very focused on providing brokers and customers with a better experience when doing business with us. Feedback from brokers is that our turnaround times are no longer an issue, and that is not something we've been able to say in the past. I can also confirm we've been managing comfortably within our capacity under regulatory limits. The increase in broker volumes has also been assisted by the convergence of serviceability tests, as well as income and expense validation requirements across the industry. BOQ took a conservative approach to regulatory requirements and moved quickly to enhance practices in prior periods. We are pleased to see that others are now moving in line with practices we've been operating under for some time. The Virgin Money Reward Me home loan portfolio has exceeded our expectations in terms of growth, delivering $700 million in loan balances since its launch. We remain optimistic about the outlook for this business and are working on plans to expand its banking product offering. BOQ Specialist has continued to deliver strong mortgage volumes, with its portfolio growing to $3.8 billion. This is from a zero base when we acquired the business in 2014. By meeting the needs of medical professionals early in their career, we are building a pipeline of future commercial and retail lending opportunities in this sector. There is no doubt the macroprudential regulation is having an impact on the mortgage market. We are seeing intense competition for owner-occupied principal and interest loans. While we expect system and credit growth to moderate, we are confident in our diversified channel strategy. We've also made good progress in growing our niche businesses during the year. BOQ Specialist delivered strong loan growth across both its housing and commercial loan books. This business now serves more than 30,000 customers, which is up from around 19,000 when we acquired the business. BOQ Finance made another strong contribution. Since its acquisition in 2016, the cash flow finance business contributed revenues of $7 million and a profit after tax of $2 million. This is in line with expectations. Our business banking target segments have continued to grow, albeit from a small base. Loan balances in niche business banking segments of agribusiness, corporate healthcare and retirement living and hospitality and tourism have grown by $309 million to $1.5 billion. During this period, we've built out our capability in the niche segment of corporate healthcare, leveraging our industry expertise and contacts through BOQ Specialist. Turning to slide 9. The resilience we've built into the bank is becoming increasingly evident. Impaired assets as a percentage of the total loans is down to 44 basis points, while loan impairment expense was just 10 basis points of total loans in the second half. The commercial loan portfolio is in very good health, which is evident in the long-term arrears chart on this slide. Meanwhile, the BOQ Finance portfolio only recorded $2 million of impairment expense in the second half, or 9 basis points of total loans. This is an unusual low level which we'll expect will normalise in future periods. The housing portfolio remains solid, although there has been a slight uptick in arrears, driven primarily by stress in central Queensland. Overall, we remain very comfortable with the health of the portfolio. There are no signs of systemic stress emerging. Another highlight of this result is our disciplined approach to cost management. We have delivered on our 1% underlying expense growth target with underlying expenses of $510 million. We've achieved this while still investing in the business. Included in our underlying expenses are costs associated with the rollout of the Virgin Money mortgage product, as well as the BOQ Specialist mortgage expansion. We are also continuing to invest in digitising our processes, which will have the dual benefit of improving customer experience as well as improving efficiency. In 2017, we established a mortgage hub, bringing teams across the group into a centre of excellence for mortgage processing. Supporting this is the retail lending origination platform which enables mortgages to be processed faster and at a lower cost. The first phase of our enterprise web experience platform has been rolled out. Virgin and BOQ specialists are currently operating on this new platform, with plans for BOQ to join early in the new calendar year. We continue to invest for the future, and I'll provide some more information on this in the Outlook section. Moving to capital and funding on slide 11. Our customer deposit growth has been pleasing. We have grown our at-call transaction account balances at a compound annual rate of 9% since 2015. We've achieved even stronger growth in mortgage offset accounts at a compound growth rate of 32%. This demonstrates the growth in main bank relationships, which is important for the long term and is a very good result given our reduction in branch numbers. It is a good indicator of the improving performance of the network and our increased focus on deposit gathering. Following APRA's clarity on questionably strong, we believe we're in a very strong capital position at 9.39% Common Equity Tier 1. Anthony will go through some of the tailwinds which would further strengthen this position by 20 to 25 basis points. This provides us with flexibility to consider capital management options. In response to these changes and BOQ's position, the Board has determined that returning some of this additional capital to shareholders is the most appropriate course of action at this stage. In addition to the determination to pay an 8-cent special dividend, the Board has suspended the dividend reinvestment plan. Looking at our progress against strategy on slide 12, and I'm pleased to report that we've delivered on our objectives. We've expanded channels for customers to engage with us, including mortgage brokers, as well as enhancing our digital capability. We've continued to grow the right way, pricing for risk, and appropriately and targeting segments that value our relationship proposition. We have found better ways to doing things to keep our costs under control while also investing for the future. And we continue to strive to be loved like no other through ethics, diversity, leadership, and our people. I'll return to talk about strategy and the focus going forward. Anthony will now take you through the financials in more detail.
Thanks, John, and good morning. I'll start on slide 14, which sets out our profit and loss. On a headline basis, our cash earnings after tax increased by 5% to $378 million. This was driven primarily by a 28% reduction in loan impairment expense. On this slide, we've also shown an adjusted result, which strips out the $16 million profit on disposal of a vendor finance entity where the vendor partner exercised an option of the structured program. Profit on disposal came through the non-interest income line. In addition, this profit was fully sheltered for tax against previously unrecognised capital losses. Adjusting for this impact, our cash earnings after tax increased 1% on the 2016 financial year. We did see a much improved performance in the second half, and I'll take you through that in the next slide. Again, we provided adjusted figures here to strip out the $16 million profit from the vendor finance entity disposal. After adjusting for this, you can see the business has delivered a 7% increase in earnings in the second half. This was driven by net interest income growth of 5%, underlying profit growth of 4%, as well as a 22% improvement in loan impairment expense. I'll now take you through the key drivers of each of these lines in more detail. Starting with the loan portfolio on slide 16, following a contraction in the first half, we did see a return to growth in the second half of the year. Pleasingly, the loan portfolio continued to diversify geographically, with Queensland concentration now down to 46%. Digging into the retail portfolio, and I'm now on slide 17. All distribution channels demonstrated improvement in the second half. The chart on the top right shows monthly housing settlements by channel, and as you can see, our owner-managed branches are still our biggest contributor to our monthly housing loan settlements. Overall, we saw much better momentum in the second half as credit settings, particularly around validation requirements of customer income and expenditure, became more aligned across the industry. The uplift in broker volumes is the best evidence of this, with loans originated through brokers, including under the Virgin Money brand, contributed 28% of our home loan settlements in the second half. Moving to commercial loan growth on slide 18, and as you can see on the bottom right, the portfolio grew strongly in the second half. This followed a first half which was impacted by a small number of large customer paydowns. Across the full year, we saw solid growth in the BOQ branded portfolio of around $300 million. Our target niche segment strategy is delivering. We had strong new customer acquisition across agribusiness, corporate healthcare and retirement living, and hospitality and tourism. BOQ Finance and BOQ Specialist also delivered solid levels of growth, with BOQ Finance particularly strong in the second half. BOQ Specialist commercial growth was slower in the second half than in previous years. Settlement volumes have remained at consistent levels, but there was an uptick in runoff that slowed the rate of growth. We continue to see strong growth prospects for this business. Growth will be supported by the early life cycle customer acquisition strategies that the BOQ Specialist team has been employing. Graduate customer acquisition success has been very pleasing and will deliver long-term value. Lastly, I'll point out Queensland concentration in the commercial book is now down to 38%, which we believe is a good level of diversification. Changes in concentration levels going forward will now reflect underlying business opportunity. Looking at the funding side of the balance sheet, and I'm now on slide 19, our lending growth has been fully funded by deposit growth. Our deposit to loan ratio finished the year at 69%. There's also been an improvement in the mix of deposit funding. As John's already touched on, we've had good momentum in growing our main bank customer relationships. That is evident by our growth in transaction account and mortgage offset balances. In May, we did see some noise as a consequence of the action Standard & Poor's took to downgrade 23 ADIs across the industry, including BOQ. This was based upon concerns with residential property prices and household debt levels, particularly in Sydney and Melbourne. I would highlight that BOQ is less directly exposed to this sector of the market, and some of the relative rating outcomes across institutions in the industry were counterintuitive. We did see some impact from this action in reduced lines and higher pricing in the more rating-sensitive elements of the larger retail deposit and wholesale markets. Moody's undertook a similar industry downgrade action in the month following, but pleasingly, BOQ's rating was maintained at A3. Following this outcome, active work with the bank's funding counterparties in these segments re-established limits to levels largely equivalent with those prevailing before S&P's action. We are now paying slightly more due to the split ratings in this segment. The split rating will also impact the pricing we're able to achieve in term funding markets as our secondary spreads have widened. In the term funding space, during the half, we successfully launched our inaugural covered bond issue. This is an important element of our forward funding armoury. It provides access to a deep pool of investors that we would otherwise be unable to access. If we move on to the margin story, and I'm now on slide 20, this was a story of two halves. In the first half, we experienced a 5 basis point margin contraction, which we thought would reverse in the second half. We did achieve that profile with a restoration of our margin to 1.9%, and conditions were largely in line with our expectations. I've previously covered the ratings actions that played out during the half. If they had not occurred, the margin outcome would have been slightly better. Looking at decomposing the movement for the half, loan repricing activity implemented through the year added around 5 basis points to our margin. We also benefited by 1 basis point from the higher margin cash flow finance business that we acquired during the year. Meanwhile, the front-to-back book pricing dynamic continued to be a drag on margins with a 4 basis point negative impact. This is driven by lower rates being offered on new loans and to retain existing customers compared to the average of the portfolio. We expect this dynamic to continue. The funding cost and mix changes improved margin by 5 basis points. This was driven largely by a retracing of spreads on term deposits that had widened significantly in the first half. Capital and low-cost deposits, or the return on our replicating portfolio, was a 2 basis point drag on our margin and consistent with our previous guidance. Looking ahead, we see a further 1 basis point impact from this element of the margin movement to come through in 2018, after which it will be largely neutralised. This profile is based upon the forward interest rates implied by the current yield curve. The outlook for NIM, as always, is hard to predict. There are a number of variables that make forecasting the forward profile difficult, so we won't be providing guidance for overall NIM. However, we can provide some detail of the known or measurable elements that might make your own assessment of the forward profile somewhat easier. Looking at the half ahead, the impact of repricing actions that have been taken to date will benefit the first half 2018 margin by around 5 basis points. We would expect the front to back book margin impact to continue. We are closely watching the level of competition in owner-occupier P&I lending, as well as the switching of our customers from interest only to principal and interest. I've mentioned that we also expect a further margin contraction caused by the capital and low-cost deposit portfolio in 2018. We expect this to be about 0.5 basis point per half. We do, however, expect some benefit from hedging costs of about 1 basis point. Hedging costs have reduced. New hedges are being set at lower rates compared to those that are rolling off. Now, the last large remaining element of the profile is the funding costs and mix. That's a very dynamic item. The last half did see an improvement of 5 basis points, and we think that level of improvement is unlikely to be repeated in the next 6 months. However, as we sit here today, and if current dynamics remain, we would expect this to be a positive contributor to the margin in the first half. Lastly, we've shown on this slide, on the waterfall, the impact of netting of mortgage offset balances against interest-earning assets in calculating net interest margin. This calculation methodology has emerged over recent periods as an industry standard. The impact of this is a 6 basis point difference in the calculation. We will commence reporting margins on this basis from 2018. Moving to non-interest income on slide 21. Although the headline result was fairly stable for this line, the 2017 result was supported by the $16 million profit on the disposal of the vendor finance entity that I mentioned earlier. This transaction arose from a contractual arrangement with one of our BOQ Finance vendor partners. We had established a special purpose vehicle in 2015 to provide finance to the vendor's customers. The vendor partner had an option to acquire the financing entity and chose to exercise its option in the latest half. I'd also reiterate that we had some capital losses that were unrecognised, and we were able to eliminate the tax on the disposal profit. That's why we have a lower tax rate this year compared to more recent periods. If we strip out the $16 million, it was another tough year for this line, with reductions across most categories. Banking fees continued to reduce as customers opt for no or low fee products. St Andrew's contribution reduced on the prior year, but the past 3 halves have stabilised at $10 to $11 million per half. Meanwhile, opportunities to generate trading income have also reduced significantly. We expect the impact on the bank's owned ATM network following recent industry changes to be a further $1.5 million headwind in the 2018 financial year. On the positive side, we are seeing some growth in our financial markets customer revenues, which we expect will continue, with further investment in the product suite and a digital delivery platform to be released over the coming year. And we've seen solid growth in our Virgin Money third-party distribution business. While we continue to explore all avenues to generate additional income, it's fair to say it will remain difficult to maintain non-interest income averaging around $80 million per half, but that's what we'll be aiming to do. Shifting to expenses on slide 22, and we've been pleased with this result. We've delivered the savings we needed to keep our underlying cost growth to 1% this year. We've also achieved this while absorbing higher IT software amortisation and a full year impact from the rollout of the Virgin Money mortgage product. The cash flow finance business that we acquired during the year added $3 million to our operating expense base, and we would expect this to be a $4 million impact on a full year basis in 2018. We continue to target a sub-inflation growth profile while continuing to invest in transformation and supporting our growth businesses. We believe we can achieve this by delivering on our continuous improvement focus and harvesting the benefits of the transformation initiatives we are implementing. Looking now at asset quality, and I'm on slide 23. This is a very pleasing story. Loan impairment expense was down 28% on the prior year, with reductions across all portfolios. Total impaired assets and the emergence of new impaired assets also decreased from 2016. The housing portfolio does continue to benefit from record low interest rates and a strong residential property market. The BOQ Finance portfolio delivered an exceptionally strong second half result of just $2 million. That represented 9 basis points of losses on that portfolio. We would not expect this to be sustainable. We believe this segment of the market should see through the cycle loss experience around 70 basis points. However, the very strong arrears performance in that portfolio, which I'll cover later, suggests that there are no indicators it will return to those levels in the immediate term. The commercial portfolio included one new impairment of an exposure greater than $10 million. This exposure relates to a large central Queensland property developer and investor, totalling $29 million. It was previously identified as outside of risk appetite under the revised settings established in 2012. It was being actively managed with limited options for refinance, but moved to default in the half. Deterioration in collateral asset values in central Queensland has resulted in a specific provision charge of $16 million for this exposure. In 2012, there was a significant portfolio of larger performing exposures identified as outside of risk appetite. At that time, a collective provision model adjustment was established, which has been maintained without change until this half. This new Central Queensland impairment is the last remaining large exposure from the portfolio identified in 2012. As a result, the collective provision model adjustment has been reduced accordingly. This has had a $14 million impact in the half. The portfolio impairment data on the chart on the top right of the slide adjusts for these two items to provide a better view of underlying portfolio performance. Although provisions, and I'm moving on to the slide 24, provisions reduced during the year, this was in line with improvements in credit quality metrics across the portfolio. The bank has been building a new collective provision model. The new model is in the final stages of validation and is expected to be adopted in the first half of 2018. The new model has been designed to address the requirements of IFRS 9 that is scheduled for adoption in the 2019 financial year. The introduction of the new model is not expected to have a material impact on collective provisions. However, we do expect a likely reduction in the current level of general reserve for credit losses, the impact of which I'll discuss shortly. Our provisioning coverage continues to compare favourably with our peers when looking at collective provisions and general reserve for credit losses relative to risk-weighted assets. Moving on to arrears, all portfolios have performed well. In the housing book, 90-day arrears increased by 9 basis points over the half and 3 basis points for the full year. We have seen some impact of continuing softening in the central Queensland economy, as well as a delayed effect of Cyclone Debbie in Queensland. Commercial arrears continue to track at solid levels, with no areas of concentrated stress evident. BOQ Finance 30-day arrears have reduced significantly and at 47 basis points is at the lowest level we've seen for the last 6 years. This is a direct leading indicator of near-term impairment expense in this portfolio and points to a continuation of the low loss rates we've recently experienced. But I'll reiterate, we don't expect this level to be sustainable over the longer term. Moving to capital on slide 29. Our underlying capital generation was 14 basis points in the second half, which helped to boost our Common Equity Tier 1 ratio by 10 basis points to 9.39%. There are two impacts expected in the first half of FY18 that will further improve Common Equity Tier 1 by 20 to 25 basis points. The largest impact relates to changes being introduced to APRA's APS 120 securitisation standard that will be effective on 1 January 2018. For some time, we have had higher average risk weights on our mortgage portfolio than some of our competitors. It appears as though we were applying a more conservative approach to risk weighting calculations, albeit we did confirm with the regulator that we have been applying the technically correct approach. Changes being introduced to the standard will allow for more of our mortgages to qualify for concessional risk weighting treatment. Our ratios will now better align with our peers. The remaining impact in the 20 to 25 basis points relates to an expected reduction in the general reserve for credit losses that will coincide with the implementation of the new collective provision model that I covered earlier. We have been pleased with the clarity provided by APRA's guidance on Unquestionably Strong in July this year. Although there is still some uncertainty around the risk weighting framework, we believe it is appropriate that a conservative capital profile is maintained. Whilst it may be possible to target a lower capital level when the rules are finally clear, it may take some time to ensure all stakeholders are completely comfortable with a fully optimised target, given the headline ratios of the major banks. In the interim, we believe a Common Equity Tier 1 ratio of 9.25% is appropriate. In light of this, the Board has announced the special dividend and the suspension of the DRP for this dividend payment cycle. That equates to approximately 27 basis points compared to not having announced those steps. That leaves some additional excess capital that, together with the current profile of capital generation, provides optionality for us to consider how best that can be deployed for long-term shareholder value creation. It obviously provides some capacity to grow faster than we have been, but we will remain conscious of the return impact of using price to deliver that outcome. We are currently considering options for using some of that capital to accelerate our transformation and achieving digital parity in our customer fulfilment options. There is more for us to consider, and if or when any decision is made, we would update the market accordingly. Lastly, if we can't find appropriate opportunities to deploy capital excess to our target, it will be returned to shareholders. With that, I'll hand back to John.
Well, thank you, Anthony. There is no doubt that the environment we're operating in is changing rapidly. Regulatory, legislative and political pressures require banks to be more focused and nimble than ever before. Customers also expect more from their banks, particularly in terms of trust. At BOQ, we take the issues of culture and conduct very seriously. We took a leadership position in signing up to the Banking and Finance Oath, established an ethics committee in 2015 and have completed the rollout of ethics training to senior staff and owner-managers. While the Financial System Inquiry made a number of positive recommendations, the playing field is still tilted in favour of the major banks. More needs to be done in this regard. Before any new regulations are introduced, greater consideration should be given to the impacts on smaller banks. Meanwhile, technology developments continue to move at pace and with it customer expectations. For a bank to remain relevant in this environment, ongoing investment is required. The economy is improving, albeit mixed. Business confidence is high and jobs growth has been strong. With the unemployment rate around its decade average and interest rates low, loan losses have been minimal. But the consumer has been weighed down by stagnant wage growth, rising utility prices and relatively high underemployment. In Queensland, the South East is performing well. Agriculture, tourism continue to support the state. Central Queensland is still doing it tough in its larger regional centres. Overall, though, we are positive about the outlook for the Queensland economy. Given the concerns about the housing market, particularly in Sydney and Melbourne, regulatory limits have been imposed to curb lending to higher risk segments. This is expected to have the effect of slowing credit growth across the economy. It has also meant that lenders are adjusting their rates and credit settings on a daily basis to manage volumes, margins and regulatory requirements. We do see a more favourable set of operating conditions for our business bank, where opportunities improved from 12 months ago. Our niche business areas of corporate health care and retirement living, medical, agribusiness, hospitality and tourism all have good momentum. Our leasing business provides valuable insights into the SME market and we're seeing growing momentum. Turning to slide 30 and our strategy. We remain committed to our strategy of targeting niche customer segments that value a more intimate relationship. The 4 pillars of our strategy remain relevant and unchanged. Under the customer in charge pillar, we are seeking to achieve digital parity and deliver a seamless experience to our customers across channels. Our success in this pillar will be measured by the delivery of enhanced digital customer platforms. We'll focus on growing the right way by improving our deposit gathering capability and increasing our main bank relationships. We'll price for risk while considering the broader relationship with our customers. Our MFI customer growth will be a key indicator of success in this pillar. We continue to look for improvement in all of our processes, removing friction points, with the aim of ensuring a quicker time to yes to all of our customers. To this end, we are targeting sub-inflation operating expense growth while still investing to grow our businesses. We remain committed to proving it's possible to love a bank. We will demonstrate this by a continued focus on our customers and the value we create for them. This is a people business, and to support our vision, we're rolling out a customer heartbeat program across the group. The purpose of this program is to ensure we consistently meet our customer expectations through a unified service mission. Our key driver of future success will be the delivery of our digital transformation. Initiatives we have in the pipeline include a new web experience platform for BOQ, as well as a new internet banking platform and a mobile app. Success on these initiatives will bring the bank closer to its customers. Additional services will be provided that we've not had in the past, such as a direct online foreign exchange. We do see good growth opportunities in our business bank. We'll continue to report back on our progress. In summary, our niche strategy is delivering. Our distribution channels of Virgin Money, brokers, BOQ specialists and the branch network give us greater reach than we've had before. We are cautious around the housing loan market, given that system growth is likely to slow. But we are rolling out a range of initiatives that will improve the way we do businesses and serve our customers. Our business bank has had an excellent second half. This has continued into the new financial year with a strong pipeline and settlements. Our strong capital position provides optionality for long-term shareholder value creation. We've delivered a sound result at the same time as making significant progress on transforming the business. Whilst there's more for us to do, we are laying the right foundations for sustainable outperformance in the future. Thank you, and I'll now hand back to Tani to moderate the Q&A.
Thank you, John. We'll begin by taking questions from analysts and investors only. For those in the room and for the purposes of those listening and watching the webcast, can I just ask you to state your name and organisation you represent? So we'll begin in the room. Let's start here in the front, please.
Good morning, Sandra standing from Morgan Stanley. Congratulations on a solid result. Could I just ask about margins and switching from interest only? Are you seeing something that would suggest about 25% switching from interest only into P&I? And have you considered that in the 1H18 margin commentary you've just provided?
So We only put through our changes to interest only a month or so ago, and it's very early days yet on the switching. We have seen some switching. We did also plan for switching and further discounts, but the rate that we're seeing is probably less than what we had expected.
It's probably a bit early to make that call at the moment. There's a little bit more time that I think we need to continue to watch it. I think we did call out that we are watching that element closely, and that will have an impact potentially on the front to back book dynamic.
Thank you. And sorry, is this working? So thank you. And second question then, you said you may accelerate the digital transformation. What kind of investment return hurdles will you be considering in terms of evaluating whether you should accelerate that?
We're in a very strong position. Our capital position allows us to actually grow risk-weighted assets, which we would like to continue to do. We also, and I've talked about this in the past, the last few years. We had to get rid of our fax machines, which we've done. But we do want to be contemporary with our digital offering. We're not going to disclose what the individual hurdle rates are, but customers dictate how they want to deal with banks, and it is important that we continue on our journey to digitise the bank. There are two benefits for that. Obviously, we maintain our customer base and grow our customer base, but we're also very mindful that the investments we make, shareholders get the return.
I think I've got a question here in front.
John Mott from UBS. Just following up on the digital transformation, to me that just sounds like stay in business capex. Every bank in Australia has to do that, and there's no competitive advantage to this kind of investment. So you'd have to assume that all the benefits that you expect are just going to get competed away as all the other players go through. So I'll ask a question on that. How much do you expect you'll need to spend in costs, assuming that there's no revenue benefit? How much will the digital transformation spend?
I'll let Anthony talk about the cost side, but I will take one point of differentiation, John, with your comment is that we touched on it briefly in our opening remarks. We are spending money on our treasury back office and systems, and also we're spending money on our digital FX offering. Now, BOQ has this customer base in BOQ Finance, great customer base in BOQ Business, a great customer base in BOQ Specialists, and a very strongly growing customer base in Virgin. Now, I'm an old foreign exchange trader, and we really believe that investment will generate some very good returns for the bank, but also for consumers as well, because that's an area where the big four banks have had it to themselves for a considerable period of time. So it's not just stay in business, it's also to create business and to support our businesses.
In those niche areas. One follow-up question then comes through. The choice of a special dividend rather than increasing the ordinary. Can you just run through why that is the case, given that you are in a stronger capital position compared to your new target? You're going to get 25 basis points additional benefit coming through. Why don't you have the confidence to move the ordinary dividend up rather than a special?
Well, I think the guidance that we'd given previously is we expected our ordinary dividend growth to mirror our EPS growth, and I think that probably answers it.
Okay, we've just got on my left.
Thank you. It's Victor Gelman from Macquarie. Firstly, just wanted to clarify a couple of points. With respect to switching, is that included in the numbers that you were talking about earlier, Anthony, when you were talking about the impact front to back book, sort of similar rate? Was that inclusive of that or not?
Look, the 4 basis point contraction that we had in this half, I think you'll find the comment I made that we expect the front to back book dynamic to continue. I think, and I made specific mention that we are watching that switching in the context of that front to back book dynamic. So, we're providing additional area of focus for the market. It will be a factor in where that number lands, and we haven't given any specific target on the aggregate of that position.
I appreciate that, but you're saying that it's tracking a little bit better than your expectation.
No, I didn't say that. I did say I did say it's too early to say what the real trend will be, but it's a little better than what we thought it would be. But you shouldn't read anything into that, because consumers, this is talked about daily in the press, and we've only had our change in for a short period of time.
Yeah, no, I appreciate it. I'm not trying to kind of get a number of you. I'm just trying to understand, is that number, whatever the outcome will be, is that included in that 4 basis point or not? Is that outside?
I haven't. There was no intention to provide a definitive number about what front to back book dynamic will be in the next half.
Okay. And then just other point of clarification. Obviously, the business that you've sold presumably delivered some earnings. In what should we be taking out for the benefit that you were getting from that business?
Yeah, the $16 million really reflects future earnings that would have been generated off that portfolio. Because the book only started in 2015, you haven't had any maturity of those customers through to the end of their lease term, after which you would get the asset realisation revenues or the inertia income, which is effectively the bring forward that reflects that $16 million. So the earnings that have come through in this period reflects a portfolio of a little under $100 million, and it's the net interest income on that portfolio.
Immaterial. Okay.
Can I just ask
other
everyone
income.
to limit their questions to 2, please, because we've got a lot of questions on the phone as well. Sorry.
Sorry. There was just clarification. Now comes just one question. In terms of volume growth that we're seeing, obviously we've seen improvement in the half, which is kind of what you've guided. But one of the channels that's still struggling is BOQ channel. Just interested in your observation as to how you expect that to go in the next half, and whether you actually expect to see that channel to deliver growth.
So our owner-manager channel is the backbone of the bank, and an owner-manager branch, as I've said at previous results presentations, will outperform a corporate branch of a Big Four bank day in and day out. They live and eat and breathe their community. We're seeing growing confidence coming back into our owner-manager network, and also, which is really pleasing, we run a balanced scorecard for our owner-managers, which is really important that they are serving the needs of all of our customers in the right way. And we've got close to 80% of our owner-managers on that new balanced scorecard. We're already starting to see some changes, particularly around deposit gathering. We've recently put foreign exchange on the balanced scorecard, and we've seen a good increase in foreign exchange needs for serving their customers. What is also pleasing about longer term for BOQ is this business is materially different to where it was 5 years, which was a monoline distributor of mortgages. We now have Virgin Money that has delivered $700 million of mortgage growth in a very short period of time. We will add further products to that. We have BOQ Specialists that we acquired in 2014 that was sending their mortgages off to other banks. We've grown that from $0 to $3.9 billion. We've also back with the broker channel, and there's no doubt we've had teething problems in the past with the brokers, but we are working really, really hard with that important channel to make sure that we can deliver on their expectations as well. So from my perspective, we have some really solid foundational avenues of growth across a range of great brands.
And I would also just add to that you've also got to look at the deposit side of the equation as well, and it is as John says, the lifeblood of a branch of a bank is the deposit gathering capability of your branch network.
Okay, I might just take one more question from the room and then we'll go to the phones. Just here in the front, please.
Hi, it's Anthony Hu at Deutsche Bank. Just a question on non-interest income. You've alluded to pressure as customers go towards low-fee products. Can you talk a bit about the outlook for these and how you position in terms of, given the broader environment, including political factors, seem to be pushing the broader sector again? This seems to be renewed pressure against fees and the like. So, can you comment on how you position and what you think the trends are?
The trend is pretty clear. There is a lot of discussion in the community around where banking fees may go, and we quickly made the changes to our ATM fees, which Anthony spoke about.
Look, I think the areas that we're focused on in trying to ameliorate those headwinds are in extension of our capabilities to our existing customer base. And John mentioned the foreign exchange capability that we expect to deliver over the course of the next financial year, that we do see opportunities in that space. So that's the other levers, I suppose, that we're pulling that we haven't had penetration in, that we arguably should have within our existing customer base.
But if we exclude the sort of mitigation options they're pursuing in terms of existing products, do you think there's still a lot more fat to go through in terms of the fees, or do you think you're largely done? Or
I think from our perspective is that we do want to absolutely remain competitive, and the industry, this is an industry comment, the industry comment is facing pressure across a range of fees.
Okay, we'll take a question from the phones.
Your first question comes from the line of Craig Williams from Citi. Please ask your question.
Thanks. I suppose it's in some ways a bit of a follow-up from Anthony's line of questioning. I mean, you talked about macroprudential policy slowing credit, mortgage repricing looks challenging from here, and the industry is giving away sort of extraneous fees at present, so it sort of paints a backdrop of a challenging revenue outlook. Does that revenue backdrop therefore signal that yourself and the industry needs to take a much more aggressive focus on the cost base of your business?
I'll address that in two ways, Craig. I think from our perspective is that we've got these lines of businesses that are growing as well. So if you have a mortgage market or credit system growth that is slowing, what is really pleasing and what we are seeing is that our niche strategy, particularly in our commercial bank and the niche businesses that we're targeting, has good growth. And when I think about the commercial bank, not only on the business bank side, not only is it just the straight lending, but it's also leveraging BOQ specialists for leasing. It's also meeting all the needs of the medical professionals that we service through BOQ specialist. BOQ Finance has a huge customer base that we barely touch, other than the one product of leasing. So for me, that gives me some comfort against the slowing mortgage market. On the cost side, we've been really clear about our guidance on costs, and we're really pleased on what we delivered this year, but we will still continue to have a laser-like forensic focus on our costs to find additional headroom to make the investments to grow this business.
We'll take another question from the phone.
Your next question comes from Frank Podrug from Merrill Lynch. Please ask your question.
Good morning. A couple of questions from me. First is your attitude towards future covered bond issuance as part of the funding strategy. So you're well under the limit. Such funding is typically longer tenor and cheaper than unsecured wholesale funding given its nature. So where do you see that going?
Yes, so we just completed our first inaugural issue earlier this half. Over time, we do see that program maturing. So, we'll probably have 3 to 4 transactions out across a duration curve in full maturity. Obviously, that'll take us several years to put into place, but there is definitely an opportunity there. I suppose that the thing I would call out is our thinking at the moment in that space is that we are able to attract an investor base in offshore markets, and we went to Europe in our inaugural deal that we simply couldn't attract off our unsecured balance sheet. And whilst you pay a little bit for the cost of bringing that back on shore, so you're getting that effectively at your senior unsecured domestic credit curve, roughly. We see that as a pretty important avenue to allow us to continue to grow over the longer term without putting any pressure on any of our domestic funding capacity. So I think that's an important thing to call out.
Okay, thanks. And the second question, so I know you've had a couple on it already, but the path to achieving sub-inflation expense growth, given you had a 4% sequential increase in your FTE You're continuing to invest. Where do you see the offsets coming from?
We have some cyclicality, as you will see in our half-on-half profile. First half expenses do tend to be lower. There's a little bit of annual leave timing, accrual piece impact in that sort of thing, so and we continue to extract efficiencies in the way we operate. So we've had some benefits on the other side of the ledger, but I think you'll see that cyclicality pretty consistently.
Okay, we'll take another question from the floor here in the front. Got Richard.
Good morning, Richard Wiles, Morgan Stanley. A couple of questions, John. Firstly, you chose to do a special dividend, which I think uses about 10 basis points of capital. You've got 20 to 25 coming in the next half, so why not do a sort of $100 million buyback, lower the share count, improve a future ROE, rather than doing a special dividend? And second question, on the ATMs, I'm wondering how much it costs you to run your network, and is there any reason why you wouldn't just close it down and let your customers use the major bank networks in the future?
I'll deal with the ATM piece. We have a lot. Our ATMs are near our branches. We're also part of the Ready network. We're also in a lot of regional areas as well, Richard, and I think that would be not a great idea to be shutting your ATM network down in regional areas. And being a person who grew up in a regional area, I think it's very important that they actually have access to ATMs. But certainly, we made some changes to our ATMs fleet last year, and that they're much more contemporary, which also gave us some significant savings on the way we operate that fleet. I'm going to pass to Anthony on the capital question, but we did look at many different options and we arrived where we arrived at.
I mean, I think the overarching conclusion is that the special dividend profile liberates franking credits out of the organisation that otherwise would be trapped within the organisation. And whilst that's not necessarily the preferred outcome for every investor across the register, certainly all of the discussions that we've had about the payout ratio profile that we've had in the past has, on balance, pointed us towards that direction. We're also conscious that in the steps that we've taken that the board announced today, a lot of the changes that we're talking about coming in, that 20 to 25 basis points, is a 1 January first half style impact, and so we just wanted to be again conservative in the way that we manage that profile over the next 3-4 months.
I think Ed, you had a question.
Thank you. It's Ed Henning from CLSA. A couple from me. Firstly, if you look at your home loan, and you're still obviously well below system, and you talked about some of the things you're doing. Can you just run us through kind of how you're going to get up to system? You said, John, you're doing 28% through the brokers. Your peers are much higher than that. Is there any still to go on the transformation of your lending process to kind of help that get through? That's just the first one.
We've rolled out our new lending process, particularly right throughout BOQ and the BOQ broker network. We are now actively looking at putting that through to Virgin, and we will look at that over time for BOQ Specialist. There's no doubt that the macroprudential changes have started to slow credit growth. We still maintain our credit settings, and it will take us time to gradually build back towards system. But it's really important that brands such as BOQ Virgin have strong resonance, and they do attract a materially different customer to what we actually have at BOQ, and we'll continue to grow the Virgin brand. And BOQ Specialist still remains an engine of growth for us, particularly in mortgages. And if you look at the other banks, they're probably doing 50% through brokers. We're combined with Virgin and BOQ, we're at 28 at the moment, and there is scope for us to further increase that.
And you talked about you don't think there's any more bottlenecks in the broker channel. As the process, you're now happy with it. Is there any further tinkering you need to do to improve that, to get the brokers to push your brand more?
well, there's a number of ways to get brokers to push your brand.
Other than price?
And we're not going to go and pull the price lever, and we're very mindful of both sides of the balance sheet, and particularly on deposit sides, and the NIM on deposits and NIM on acquisition pricing. What I will say on acquisition pricing, it has become pretty competitive over the last few weeks. But with brokers, it's constantly about serving their needs, listening to what they need and what they want. And we've got good, experienced people on the ground that are talking to brokers day in and day out. Will we always get it right? Probably not. But we are in a much better position with our centralised mortgage hub that have got the risk teams together, the validation teams together, to get a quicker time to yes to take those home loan customers off the market.
And just the second one, you talked about the potential investment in technology. What do you guys still need to do to catch up to peers or take over some peers?
Have you ever used the BOQ app?
No, I haven't.
I've got three sons that have used the BOQ app, and we need to make it more contemporary, and that's where we want to go. So we will continue to make those investments that are needed to get us closer to our customers, and that's what our customers expect and demand from banks.
As we talked about in the strategy briefing that we had here a couple of months back, a lot of the technology architecture that we're moving towards, a lot of institutions in our space have moved on to much more dynamic infrastructure environments with the use of cloud. We're really just in the early phases of thinking through our path in that regard. And there are a lot of opportunities to modernise our network. We did talk that day about simplifying the organisation such that we can onboard and onboard new capability and fulfilment from outside of the organisation to assist us in becoming genuinely nimble. And we do see that's the prize for the organisation.
A tangible example of that is at the moment, if we wanted to do some testing on a new Virgin deposit product, the ability for us to put up a test server and pull it down as and when we need it is fairly limited, which really delays our time to market. So, some of the changes and investments we're making will allow us to have that greater agility to get to market much quicker with changes to pricing or changes to products or launch new products, which is incredibly important.
Okay, I might take some calls from the phone again.
Your next question comes from the line of Ashley Dalziel from Goldman Sachs. Please ask your question.
Thanks and good morning. Just firstly on the margin, just wanted to clarify what's sort of going on with hedging costs. I think you called out a plus 1 basis point tailwind going into the first half of 18, coming off a neutral sort of impact in the second half of 17. If I just look at what occurred through FY16, hedging costs or basis risk knocked about 5 bips off your margin, and I think we all use sort of a cash bills or bills OIS spread as a proxy for what's going on there, and that's tightened up quite materially just in the last few months, probably back to where it was before it drove that 5 bip headwind to your margin in 16. So why aren't you a bit more confident on that driver of your NIM into the next half?
Look, I think we've called out, so cash bills does bounce around a bit, but it has been in the sort of 23s area at the moment. There's probably about a 5-6 basis point impact on the cost of those individual hedges. So spread across the totality of the balance sheet, that equates to about a basis point in our expectation over the FY18 year.
Okay. And can I just ask a follow-up question on the investment that you're talking around on digital transformation? Can I just confirm that that's sort of completely separate to any investment that might be required if you do decide to push for advanced accreditation?
Look, I think there could be some overlap in that regard. I think, however, until we understand exactly what the risk weighting framework we will be operating in when the Basel rules get finalised and APRA determines how they will apply them in Australia. The residual size of that prize, I think, as we've talked about in the past, is still uncertain, and APRA's recent unquestionably strong guidance has probably given some clarity that that the size of the prize that might have been there previously is certainly not going to be as large going forward. So I suspect that's probably a later stage element of our transformation program, should that be the path we choose to go down.
And I just want to reiterate too, everything we've been doing in our risk management processes, our model development, all of those things lay great foundational stones to allow us, if we want to make that decision, to go to advanced accreditation. And we continue on that journey.
I think we have one last question on the phone.
Your last question comes from Brett Lemesurier from Velocity Trade. Please ask your question.
Thank you. I think you mentioned that you thought funding costs would have a positive influence in the first half of 2018, and I presume that the TD rates form a large portion of that. Would that be correct?
Yes. Yep.
So why do you have that view when your TD rates, 3-4 months TD rates, are higher than they were in the second half of 2017? They were 2.25% according to your website. Sorry, and then they increased at the end of August to 2.4, and they're at 2.35 at the moment.
Look, across the total portfolio, we are seeing the average portfolio spread reducing based upon the prevailing rates that we've got in the market at the moment, based upon the duration mix that we're seeing come through our customers.
What proportion of your TDs are at that 3 to 4?
Sorry, Brett, you just cut out at the start of that.
So what proportion of your TDs are at that 3 to 4 month duration?
Look, based upon the latest data, I'd have to come back to you, because it does move around a bit. So I'm happy to capture that after the session today.
Okay, thank you.
Okay, just back onto the floor. Another question from Richard. Okay, we'll come here first, and then Richard, you could be the last question.
Thank you. Just wanted to ask a question around loan-to-income ratio. So NAB recently said they're going to cap at about 8 times loan-to-income for new applications. Can you comment, what is roughly the average for your current book? And then if you were to cap it at 8 times, what kind of an impact could that have on volumes?
I'm very well aware of the recent research reports that have been released on this topic, and what I will say is that we always take our lending and responsible lending responsibilities extraordinarily seriously. We've been on the record in the past saying that we are a bank that validates 100% of all the mortgage flow that goes through this place, and will continue to do so. These are dynamic in nature, but we do take a conservative approach.
Yeah, we have. What I would also add is, through all of this cycle, we have tested serviceability based upon the residual P&I term of a mortgage. So we excluded the interest-only portion of the term. We stress tested all mortgage rates, not just the ones that would be to our institution, but all borrowing across the board with the relevant buffer levels above APRA's minimum requirements. And it's very clear, as we've seen changes more recently come through the broker instructions from some of our competitors, that many other institutions haven't been following that practice. And those settings have been in place for us for the last couple of years. And beyond, in relation to the serviceability on a P&I term, that was part of the new risk appetite setting framework.
Okay, that brings the briefing to an end. Thank you so much for joining us.